welcome everybody to another episode of our Risky Business podcast. So we're going to talk about gas prices, about risks, and about policy, and basically what is moving currently U.S. Energy market. We had a, let's say, eventful year, especially on the policy end, but also on the energy end. We had multiple conflicts. We had tariff policy. We had the trade deals between the US and the European Union. Obviously, US energy has become a global story. It is exporting LNG across the globe, and basically every single region in the world is connected to it. So to go right into it, I think, and the latest contents, Jeff, U.S. energy exports hit a record high in September. So maybe to sharing your view of how the gas market in the U.S. currently looks.
Lots of things to cover on the LNG side. Starting with a little history, the U.S. was an importer of LNG in 2015. That now has flipped as of 16 and now growing. We're averaging almost 16 BCF per day of exports, which when you compare that with total production is around 15% of our total production. So we were importing in 2015. We're now exporting in the form of LNG about 15% of our total. That is changing, I guess, dynamics globally now. So now what happens around the world impacts what we export. And I see probably the biggest near-term challenge with growing LNG exports. There is about 15 billion cubic feet per day of LNG exports under construction. If that 15 number sounds familiar, that's what we're exporting today already. So we're going to double that in the next 3 to 5 years, depending on how quickly this stuff comes online. Near term, there's probably 5 BCF. So a third of that growth is actually being commissioned in the next, today through the next 6 to 8 months. So how does that play into this mix? I think the weakest link that we have isn't supply. There's lots of gas in the U.S. Unfortunately, that gas is not where they're building the demand to export it. So the biggest problem I see in the market, the bottleneck that I see occurring near term, is the connection between that supply and the demand that we know is coming. It's being built. So you got to connect it with infrastructure, and to get a several 100-mile, up to 1,000-mile pipeline built, it's not a 3-month, 6-month, even 12-month endeavor. It is going to be drug out. If you expect to get that from the largest production area in the U.S., which is Appalachia, which, by the way, isn't on the coast, to the coast, it's going to be big pipelines with lots of infrastructure and lots of cost. So that's where I see currently the biggest challenge near term with not the supply that we have and not the demand that we know is there, it's coming, it's growing, it's being built. It's the connector between those two things.
Do you see a risk for overcapacity from your end? Because effectively, with all those capacities built, then the story again becomes that US is going to be reliant on global demand as well. So,
yeah, good point. There's a race to get the demand or the supply of LNG to the market, and right now I see the U.S. as the leading provider of that, but that doesn't mean there aren't other horses in the race. More is coming. Qatar obviously is growing a lot of LNG. The question is who's going to get there first, and who's going to get the contracts long-term signed to make it happen quick. Well, obviously, I think the U.S. has a head start on that. That doesn't mean additional LNG isn't coming. It is coming. I think we will be oversupplied in LNG 8 years from now. But to get there, near term, demand isn't going away. The commitment from Europe just recently to step back their target of getting rid of Russian supply shorten that timeline. Well, somebody has to have LNG very, very soon. And right now, I think that leader is the U.S.
Okay. And short term, where do you see prices developing? Obviously, in our last episode, we covered a bit the European pricing side of it. But if we look at Q4 this year, Q1 this year, what's your, let's say, take on it?
I'll tie that back to a non-U.S. link, which is Canada LNG. Canada does not today have any LNG exports. They are building Canada LNG, which is going to export 2 BCF per day from their west coast. So that market has an advantage to Asian markets. How quickly that comes online, which is being commissioned today. I looked last week, I think they're using about 0.2 BCF of supply, commissioning it. That's going to be 2 BCF. And that's going to come online in the next, again, 3 to 6 months. That will have a distinct transportation advantage over U.S. Gulf Coast LNG by anywhere between $1.50 and $2 a decatherm to Asian markets. So I see that shift again occurring between Asian and European markets, with Canada taking a slice out of that Asian market. Not that there was a lot from the U.S. Anyway, at least to China, which has imported 0 LNG this year from the U.S. They're going to take that market. They are a partial owner of supply from that Canada LNG. So I see them coming into that mix and displacing some of the Asian supply from the U.S.
But also, with all these new variables flowing around, are traders currently in general more defensive or opportunistic in looking at gas positions or even cross-commodity volatility at this point in time in the markets?
Great question. I think obviously, volatility is a key concern in our market, especially getting into this point of the year where winter is right around the corner. And this is when people are really starting to clamp down, to your point, on their positions. What is their view on the long-term market? I think what has consistently been the case, at least over the last 2 years, is risk being baked into the forward price to the high side, right? If you look out at any point now, the market 2 years from now is higher than where prompt is trading, right? And so what I think that we've done consistently, and the numbers on this, I think 11 out of the last 13 NYMEX settlement months have been between 250 and 350, right? So we talk about volatility and how volatility is always there, but it doesn't sound like it. It sounds like we're range bound in this 250 to 350, right? Forward curve suggests $4. Now we're getting into the heels of winter right now, and we're seeing December and January starting to support $4 levels. Now, the million-dollar question, do we continue the trend every month where prompt continues to go lower, right? If that's the case, then it would suggest that the NYMEX winter currently trading right around $4 should probably be closer to the 350 end of the range, right? However, I think one thing that is very important, and one thing that we try and instill into all of our customers, is to try and maintain at least a base level of hedging. Because I know that, we haven't really talked about hedging or risk, price risk in this particular call, but I think it is important, even if you have a bearish look on long-term energy, especially in natural gas, to maintain some semblance of a hedge structure, right? Whether it's 10%, 15%, I think a lot of our customers have benefited from having that forecastability in their spend for the year, right? We're not necessarily suggesting, the market runs up, let's go and hedge everything, right? Let's make smart, perhaps timely hedges, time trigger hedges, if you'd like. But there's ways that we can really address the risk that is starting to develop here in the winter. And Jeff, to your point, when I started in 2006, the company that I was working for was actually building import facilities in the U.S. So we were actually looking to bring in natural gas. Fast forward 19, 20 years later, and we are the world's largest exporter of natural gas. So I think, one thing that's interesting when it comes to volatility and LNG is that LNG is maxed out, right? I think that's one thing to keep in mind. We don't have a marginal flow available. Everything that can flow is flowing. So one thing that's interesting, I know we're talking about winter risk to the upside, is I kind of think LNG has a bit of a bearish risk to it on the US side. Because if everything is built out and everything is flowing, then if you think about a potential black swan event or some event that might happen. If you go back to Freeport in 2022 with that explosion, that took a boatload of LNG offline and it tanked our pricing there for a bit, right? So I think, it's an interesting way of looking at it. Can LNG be bearish, right? Again, if an LNG facility goes offline for any extended period of time, you're backing that gas up into the US and you're just pushing pricing lower. So just an interesting way of looking at LNG. Yes, we have a lot of it. We're shipping a lot of it. But what happens to pricing if there's a hiccup in that process and we're no longer able to fulfill our export obligations? That gas has to go somewhere. It stays here. It makes prices lower. We're being mindful of the weather. We're being mindful of all the infrastructure changes. We're being mindful of production. We're being mindful of coal retirements, whether or not they're happening at the same rate that we thought they were going to. Just a number of variables. And we haven't even really gotten into the weather of winter at this point.
Maybe it's the right point also to get Matt in the conversation, who is our policy expert here, basically because we are talking about all those LNG approvals. Obviously, they based on a regulatory shift that's happening over in the US, and basically also on some, let's say, geopolitical roadmap going on. But also, Matt, if you can, give us your view also, where is with other sources like renewables, coal, what's the outlook in the US? So basically, we can get a better picture having everything, in front of us.
This has been one of the biggest shifts we've seen in policy in a single year, obviously with the new administration starting in January. It's been impacting all levels of federal energy policy in the U.S. Really from day one of the inauguration. President Trump signed several executive orders on the first day, looking to boost fossil fuel production, and ultimately then on the flip side of that, looking to slow renewable energy development. So there's been a conflict there. And you really can't talk about U.S. energy policy without talking about the One Big Beautiful Bill that was passed in July. That is the key bill key law for the Trump administration, really rolling out all of his priorities for the first year or two of the administration. And on the energy side, it has significant impacts. So first, again, kind of doubling down on trying to put the weight of the federal government behind fossil fuels. So removing LNG pause that was from the Biden administration and being able to move those approvals forward happened earlier in the administration. And then with the One Big Beautiful Bill Act, the fossil fuel provisions include expanded access to federal lands and waters through mandatory lease sales, minimum lease sale requirements, opening the Arctic to drilling, reducing royalty rates, a slew of actions that are meant to boost fossil fuel production in the U.S. And then on the flip side of that, looking to slow renewable energy development by removing tax credits, including the 45Y PTC and 48E ITC, specifically only for wind and solar. So we expect that to have an impact in the near term as developers are going to look to construct and secure offtake for these wind and solar projects as quickly as possible ahead of that tax credit phase out period. Ultimately, we expect that to slow the growth of renewable energy once those tax credits phase out at the end of 2027. At least will slow the growth of wind and solar, at least in some regard, but it's certainly going to impact project economics as they lose those tax credits, which are very impactful for the overall costs. I think one of the things that we have to be mindful of too is that there's a slew of other actions from the administration that are somewhat at odds with the energy policy. So we had OBA signed in July, and we haven't really been able to see the full impact of that law yet, as it's still new, but we aren't seeing the boom in production. And that is at least partially due to some of these other actions, including tariffs and the trade war that we've seen unfold over the course of the administration, really increasing costs to build and construct new facilities, new pipelines, things like that. At this point, it's been very volatile and it's been changing rapidly from day to day. And I think a really good indicator of this was the Q3 Dallas Federal Reserve Survey. This was released at the end of September, and it polls oil and gas producers to kind of get a pulse of what's going on in the market. And the comments from that survey are really telling, talking about primarily referencing political volatility, rapidly changing costs, the inability to plan or really have any type of long-term security or outlook on capital spend because of these rapidly changing costs. So I think right now it appears some of the talk around supporting fossil fuels is a little bit more political posturing than actual, productive policy. It's at odds with the reality of the market. So I think that's going to be something that's really interesting to watch as this unfolds. And then if you take all of this, in totality, so, you're looking at reducing the build out of renewables. So you're slowing the build out of the quickest deploying assets and the cheapest deploying assets in wind and solar. We all know the demand growth that we expect to see from data centers and AI in coming years. And then you pair that with an increased reliance on fossil fuel generation to backfill that for electricity generation, increased LNG exports. So there's a lot going on in the market, and all of these factors potentially could put upward pressure on electricity prices for the back half of the decade, and then potentially just introduce more volatility to U.S. gas markets, as well as, we're trying to backfill and meet the demand growth for AI and data centers with the loss of renewables.
Yeah, I agree with you, Matt, on a lot of that. Again, short term, there's some really dynamics playing into what you talked about. Timing of the subsidies for solar and wind being scaled back significantly. And we have all this growth occurring longer term with the data centers, and also the current administration trying to increase the supply of fossil fuel. But the problem with that on the fossil fuel side is that isn't a short-term ability to produce more. I don't see what they're doing for coal benefiting a lot in brand new mines and production. They can get more out of what they have already in play and can extend the lives of coal plants. But again, there's only so much you can do to increase production without building new mines, which isn't a 1 year, 2 year decision. That's a decades decision they're going to have to make. So it's going to be difficult to significantly increase, I think, fossil fuel production for coal long term without a more consistent policy in the next administration, whoever that is.
And maybe also to ask you, Matt, in the sense of, you mentioned a lot of those changes. We have deregulation, permitting, agency control. What do you think in the short term, talking about Q4, Q1, which of these might hit hardest? Let's say Q4, Q1. What's your view?
I think the biggest priority that I see, and it's really is becoming a bipartisan priority, is permitting reform and addressing those issues. To Jeff's point earlier, you can't build pipelines without permitting reform. You can't build transmission to get renewables online without permitting reform. And that continues to kind of rise to the top. The issue is, unfortunately, with U.S. politics right now, it's really hard to get anything done at a bipartisan nature. So that's been kind of a constant background discussion that's been going on since the beginning of the Biden administration. We keep hearing that there's bipartisan permitting and siting reform that's being discussed, and it keeps coming up, but you can't get over the finish line. I think if that is something that we can get done in the near term, that'll alleviate a lot of the issues for the back half of the decade, if it is actually substantially adjusts permitting issues on both sides and does it without a slant towards one technology or the other. Without that, I think the Q4, Q1 outlook for renewables doesn't change a ton. I think we're going to see if anything, an increase in sales and trying to get projects constructed ahead of the timelines. I could get more into the timelines for the tax credit phase outs, but there's essentially an important deadline on July 4th of 2026 and then at the end of 2027. So the near term, we're going to see a rush on the renewable side to get projects completed. I think then on the gas side, as Jeff mentioned, once LNG export facilities start coming online, it'll be really interesting to track that and what increased gas production does to market prices in the U.S. For LNG exports, as well as, again, relying more heavily on natural gas in the near term for electricity generation. So I think that's what I'd have my eye on.
Okay. And then also with all of that said, maybe to Jeff and to Stu as well, how quickly in your markets get those things priced in once it is announced?
I'll break that down into the benchmark, which everyone's familiar with, which is Henry Hub, which is coincidentally on the Gulf Coast where all this LNG growth we're talking about will be sourced from. So I see as those come online, there'll be more and more competition at the Henry Hub, so the benchmark. And I think that will have, depending on where that supply is coming from and what can't get to the Gulf Coast due to the infrastructure limits we've already talked about, I think there will be some really changing dynamics with what we call the basis differential. So the regional pricing around the country that isn't tied to the benchmark, it's regional. There'll be some really big changes, I think, volatility, good and bad, depending on where the location is you're talking about, that will have a much higher premium, again, based on probably weather, short-term, or supply long-term if supply can't get out. So I think there could be some really wide swings in basis, short-term, particularly in the winter, and seasonal even, depending on what comes online and how that affects the benchmark at the Henry Hub. Short-term is going to be some volatility around the country, and there'll be more even elevated in that volatility as that LNG comes online, and the price differential, which is compared to, again, the three majors, TTF, NBP, and JKM, the three international benchmark I kind of watch. Right now, there's a 3.3 multiplier from the U.S. Henry Hub. Again, the money's there. The question is, how quickly will that supply come online along the Gulf Coast? And the demand side, if it's a cold winter, wherever, Asia, Europe, U.S., all three, that's going to be significant volatility on pricing here and abroad.
I think one thing, Jeff, to just kind of round this out, headline risk. It has really been kind of a term introduced to, I mean, it's been around forever, right? But really in 2022, with issues in Ukraine and Russia, that's when I think the term really came about, right? When the market was moving, but to your point, Sanjay, Sunday afternoon news article makes ripples through the market, right? And I think we did that. I think we dealt with the headline risk for the last 2.5 years, and I think we're still in the midst of it. So going back to my point about the forward prices having that risk baked in, I think it's there. I think if you look out at the forward curve, I think it's taking a lot of these fundamentals, the growth internationally into account, right? To a degree, it almost has to. It's the open market, right? It's where we think the market's going to be. Now, near term, I think until that growth occurs, right, you're going to continue to see prompt month in that 250 to 350 range, right? Come Q2 through Q4 of next year, when some of that increase in LNG, I think then you're just cementing that pricing that we're seeing right now, right? So I think, long story short, my risk profile that I'm looking out over the next 6 months is that 70% chance of La Nina, right? So we're going to be potentially warm going through Q4 into a really cold, aggressively cold Q1, like we've seen in years past, where the volatility is really ripe. So again, kind of going back, I think it's important for customers to have a base layer of hedge in, right? At these levels, they're comfortable. And I think that we just need to stay abreast of the market, the weather changes, and all the policy changes that Matt has gone through.
Final question for Matt is maybe your biggest policy wild card until end of year. So any views on that one?
I still think the most immediate impact is still the tariffs and trade war that's going on, because that at this point is just such a talk about volatility. One day the tariffs are on, the next day the tariffs are off. There's been so much change back and forth, and we know that uncertainty really freezes capital markets. You can't plan to build, you can't plan to acquire capital, you can't go through this process at all if you don't have some level of certainty. And we've seen that really slow growth on construction and on all energy projects, just in some regard, as you're trying to navigate new prices and figure out what things look like on a day-to-day basis. So seeing where that goes to the end of the year, also that is still moving and happening with the shutdown still occurring. So that is one of the few things that's still at play and can happen on a drop of a dime, as we've seen throughout the year. So I think that would be the biggest risk. Just keep an eye on through the end of this year and into next year, just to see where that continues to go.
Clarity is a luxury currently, so
it's a dream.
A dream that we will keep chasing. So maybe to summarize it, but I think the signals are quite clear. So LNG, weather, structural topics, and policy will define how the year ends. and how 26 will start. Thank you for your time. And for everybody that's listening to us, thank you for listening. If you have any topics that you would like us or a different group to cover, please, reach out to us via our website, LinkedIn, personal profiles, please.